The third tool the Fed has to control the money supply is through open market operations, which basically means the Fed directly borrows money in the form of bonds, T-bills, etc. And as I said, when you buy a savings bond, you're loaning money to the Fed, and there's less money in the free market. So when the Fed wants to contract the money supply, it will make the bonds more attractive to buy. Higher interest rates, tax exemptions, these types of things. When it wants to expand the money supply, it will make these bonds very unattractive investments with very low interest rates. The Fed is constantly buying and selling bonds and debt instruments. That's what open market operations is, the buying and selling of U.S. debt on the open market. The Fed does this to keep inflation in check, with the goal of creating a stable dollar with low inflation and consistent purchasing power. Now, I mentioned there's 3 tools the Fed has. There's actually a 4th tool the Fed has, and it's a pretty scary one. The way the Fed can expand money supply through this very dangerous method has only led to complete disaster in the past. As you know, the Fed has the right to print money, and a quick and dirty way to expand the money supply is to simply print a ton of money and dump it into the free market. This has always led to hyperinflation and has led to disastrous results. Many nations in Latin America tried this and wound up in horrific conditions. If the Fed tried this policy, even in small measures, it would trigger a panic, and investors who hold U.S. debt would rapidly seek to move their investments into another currency. So, if there was no national debt, the Fed would be severely limited in its ability to control the money supply, and hence be very limited in its ability to control inflation. Of its 3 tools it can use to control the money supply, open market operations is the most powerful and most precise method to control the U.S. money supply. In the late 1970s, the U.S. suffered with high double-digit inflation, and the cure came in the early 1980s under the advice of Milton Friedman, which required, unfortunately, very high interest rates. People put money in banks, contracting the money supply. But the most important part of the cure was rapidly expanding the U.S. national debt. In the late 1970s, the U.S. national debt was around 30% of GDP. And remember, I keep saying that most responsible economists feel a healthy debt-to-GDP ratio is between 30 and 70%. So the U.S. was at the very bottom of that ratio and wasn't able to effectively control the money supply until the debt was increased. Raising interest rates alone might have solved the inflationary problems, but they also have their own negative impacts on employment, which I'll discuss in a future video. The U.S. just has a huge economy, in fact, the largest economy in the world, and it needs a significant amount of debt to control the money supply. But through irresponsible fiscal policy, our debt has entered the danger zone. It is beyond the upper limits of a healthy debt ratio and projected to continue to grow at dangerous levels. Please watch my first lesson that goes into greater detail on the debt. So, while the debt is important and it's a great tool to fight inflation, too much debt can be a serious problem. Just to recap on how the Fed works, to tie this all together. The Federal Reserve sets U.S. monetary policy. It manages the U.S. national debt. It sells the U.S. debt in the form of bonds and other investment instruments. It uses the debt to control the U.S. money supply, which in turn keeps inflation under control. And it also loans money to banks and adjusts the interest rates at which it lends money to banks is another method of controlling the U.S. money supply and influencing the rate of inflation. The Fed also prints money, but it does so with great caution as to not trigger hyperinflation. Now I'd like to look back for a moment during Alan Greenspan's time as Fed chairman. He was dedicated to fighting inflation and had very tight monetary policy. He kept the money supply low, even during times of recession, when an expansion of the money supply may have helped stimulate economic growth, may have possibly shortened the time and severity of the recessions during his time. You might say Greenspan was comfortable with erring on the side of caution to avoid high inflation. And it indeed worked. Double-digit inflation has yet to return to the U.S. Today, the Fed is under great scrutiny. The Fed chairman, Ben Bernanke, has greatly expanded the money supply as a measure to combat the current recession. There is great concerns that his actions, combined with the current fiscal policy, may result in heavy inflation. People like Congressman Ron Paul have called for greater transparency in the Fed. Others, like TV personality Glenn Beck, have called for the Fed to be outright abolished. While at the same time, our current Democrat Congress has given the Fed even greater powers. A recent conspiracy propaganda film called Zeitgeist has also been very critical of the Fed. Just a warning on this film, it's speckled with half-truths and out-of-context quotes and jumps to wild conclusions. It's important to do your own research from primary sources. Don't just take my word for it. Go and look for yourself. Go out there, dig up the facts, see how this stuff really works on your own, make your own video, explain it in a new way, hopefully better than I can, and keep informing people. Now, as I have explained, the Fed has very powerful and effective tools for fighting inflation. If for whatever reason those tools are not properly used and ineffective monetary policy takes place, it's hardly a reason to abolish the whole institution. It would be like saying, let's abolish the office of the president because we had one president that was a poor policymaker. It just doesn't make sense. These extremists on TV and these crazy documentaries are just way out of whack with reality. Also, giving the Fed a brand new set of powers may not be the most prudent course either. Ron Paul may have the right idea and let's let the Fed have a little more transparency, but these extreme examples of giving the Fed tons and tons of power or abolish it just doesn't make a lot of sense. Also, as a side note, you may have noticed that I never give the actual numbers of our multi-trillion-dollar U.S. national debt. The reason being that as soon as you hear this number, it's gotten bigger. The debt grows over $3 billion a day. So if you want to keep track of the actual total debt amount, visit the National Debt Clock website. I have a link in the sidebar. Also, review my first lesson on debt. And remember that what's the most important and relevant thing is the debt to GDP ratio, not the nominal amount of the debt. If the U.S. GDP is growing faster than the debt, hey, things are moving in the right direction. But currently we're in a recession, which means the U.S. GDP is shrinking, and the debt to GDP ratio is growing. In the next lesson, I'll discuss inflation and deflation in greater detail and what some of the causes are. I hope you watch. Thanks for watching this one. Please keep comments relevant, and please share these videos with your friends. Do some digging on your own. Make your own videos.